Hi, everyone. Welcome back to Show Me the Money. Clients come to us very often and they say, okay, how do I get in touch with these gatekeepers? These gatekeepers are stopping me. They're the ones that are in the way. I think very often of a quote from Randy Pausch, who gave his last lecture. And what he said is, the brick walls are there to stop the people who don't want it badly enough. Mm-hmm. Believe it or not, getting in touch with an agent is not actually that difficult. If you want to find out who represents an actor that you're interested in working with, go on IMDb Pro, go on the actor's profile. They tend to have all the information and the contact info of the agent. And what you effectively need to do is you need to make an offer, right? Say, hey, I'm making this movie. I'm interested in working with the actor. And this is what I am willing to put out in terms of my terms, in terms of benefits, in terms of money. But
that offer has to meet usually what they call, now I understand you no longer can you do this, but there's often what they stated was an actor has a quote.
Or precedent, right?
Or a precedent.
Like as lawyers, we run on precedent. Yeah. Mm-hmm. Not in Quebec because the notion of precedent does not exist. But litigators frequently cite precedent. Traditionally in Hollywood, in talent negotiations, precedent was important too, but it was a very different type of precedent. It was not so much a legal judgment that had binding effect, but what that person made on the preceding film. Mm-hmm. What you alluded to, though, is that quotes or precedent, people used to just say, okay, what's the person's quote? And I'll offer him the same thing, or I'll offer her the same thing. Now it's not the same. Mm-hmm. I think New York and California have passed HR legislation saying that you can't actively ask for what that actor's quote was. And the reason why is because traditionally there has been a wage gap based on gender disparity, right?
So this diversity thing and that gender now creates a situation where that quote is no longer able to be used because it would continue that disparity.
It would perpetuate that disparity, exactly. Right? Yeah. Because if 10 years ago there was a disparity and we just keep using this quote, it's just going to perpetuate this thing in perpetuity. So now you can no longer ask for that prior quote. The other thing that...
But no matter what, you still have to pay that actor what they're willing to work for.
Exactly.
And the moment we get there, that offer has to be... You have to have money attached to it.
And very often, I think this is an interesting time to bring it up, is very often what actors want is a pay or play deal. And that's like industry jargon 101. So why don't we talk about what the significance of the term pay or play is? Pay or play is effectively, I either need to act in the thing or you can get rid of me, but you still need to pay me. So either way, you're paying me my full salary. And very often people don't want to pay, producers don't want to sign on to a pay or play deal, right?
Yeah, well, pay or play means that producer who doesn't have the money yet, remember now we're in development here, right? We've got ourselves a script, okay? We may have some money up that either our equity, whatever, that we've gotten from crowdsourcing, that we've gotten from possibly, if we do the film in Canada, we've got maybe 25 to 30% of the money coming in, right? But we don't have the money yet. So if we have to now make a pay or play offer to an actor, I'm in a quagmire here. I don't have the money. How do I get that actor? And the issue is that for me to make this film, if I don't have that actor or actress or so forth, okay, I may not be able to get my rest of my financing.
That's it. Because financiers want to very often see that you have some legitimate talent attached. Yeah. And that's
in other words, I when I went to these markets, I have to tell people who's in the film, right? So I can't tell them that an actor is in a film because I can't get the actor, because I don't have the money to get that actor because the agent wants me to make a pay or play offer. So I'm in a jam here. I don't understand, John, how I get out of this.
It's a chicken and the egg thing. And the reality is so many producers who I speak to, I have a conversation. I have these conversations quite regularly. And what we often talk about is one of the big challenges of producing is that you have a bunch of moving pieces and they all need to fit together at the exact same time in exactly the right way. But you're talking about money. I don't have the money to hire, give a pay or play offer. It's a great time to move into financing, right? So,
well, actually, what I've seen happen, okay, and this is where a role of a lawyer comes in, or maybe what we call a producer's agent or something like that, okay, or an executive producer that comes on board, right? So technically, if you don't have the ability to, i.e., affirm to someone that you've got the money to make that pay or play, the offer, if you hire a lawyer who drafts a contract offer to an actor, usually what that does, and you send it over to the agency, what it does is it tells the agent comes back to you and says, hey, I'm okay with A, B, and C from your offer, but I have a problem with C, D, E, F, and so forth, right? So all of the other aspects of the maybe less money components, but all other aspects dealing. What has just occurred is a message to you as a producer that actor is actually available. Because the agent, when you would have made that offer that says, I need this actor at the end of March, okay? And they would have come back to you and said, sorry, not available, or sorry, not interested, right? But the moment they come back to you and they say, we've received your offer, but we've got an issue on some of the clauses, all of a sudden, you know the actor is available and possibly interested, or the agent at least is interested. Maybe the actor hasn't even read it yet, okay? But at least you know you're getting somewhere, so that permits you this time frame, okay, to almost be able to close up some of those pre-sale deals that you were doing in the markets, okay? Saying, hey, we've got AB, whatever actor reading this or listening to it, and I'm dealing with the agent, right? So that in the event you get the offer from the distributor that says, if you have this person in the film, or my offer is conditional on the film having this person in, you now have that commitment coming in. If you know that commitment combined with the tax credits and other money that you have together gets you the green light, let's call it, okay? You're able to then complete that pay or play offer. And all of that occurred because your lawyer was able to delay the time that you actually had to sign the offer. So sometimes, as lawyers, we actually create that have a solution for that catch-22 problem of pay or play.
So now you have your actor on board,
yeah,
right?
We got the actor, now we've got also the distributor because we got the actor on board.
So how do we get the money?
Yeah, well,
how do we finance this thing, right?
The rest of the money, yeah.
And that's the next question, right?
That's it.
So one of the ways is incentives or soft money. And this is where Canada absolutely rocks, right? So why don't you kind of just sum up the key points there, which we talked about in detail?
Okay, so we made the pitch, like you said. Now we've got ourselves a budget. We know how much we're paying because on the above the line, we've identified some of the key players and the key actors and the key directors and so forth involved, a key person being directing. By the way, just an aside on this one, in the U.S. industry, the film industry, and our classic North American film industry, it is very much guided by actors. In other words, the people who are investing with you or pre-buying your film are usually asking you to have a certain actor in a film or actors in a film. In Europe, they're looking for a director because films that were done by, Truffaut, or films that were done by Sergio Leone or something, those had a quality that was attached to that film. And it didn't necessarily matter who the actor was in that film. It was a film by Sergio Leone, okay? Or it was a film by François Truffaut. And Canada has a little bit of that, call it mixed balance, because if you look now at some of our directors like Jean-Marc Vallée or Denis Villeneuve and so forth, all of a sudden, the fact that you have that director attached to the film, even though the actors may not be there, you're already getting a positive response from the buyers in the market. So a combination of having the right director, and it could be people that are coming from, Canada or Quebec who are not as expensive, but have some weight in the market themselves, with maybe a lesser star. That type of combination may be able to get you your film financing itself. And so we were on financing, and it's integral that creative package actually form part of what I call your financing strategy. Because no matter how much tax credits we're going to talk about, or soft monies, or institutional type of funds that you have, or equity, or whatever it is, you're obviously going to have part of your financing coming from people who are buying a film for the film itself. Exactly. The story, the director who's going to direct it, the actors who are going to play in it, and so forth. So that is part of financing.
And let's talk a little bit about who those people are and how they value, right?
Yeah.
How they value the film. Who are those people?
Well, let's start with the easy one, which is your soft money. Okay, so let's start with the easiest money, I think, and then let's go to the hardest money. Okay, your easiest money, to me, is what we call soft money. Now, soft money means that the money itself that is being given to you doesn't have to be repaid. We talked about tax credits. We talked about tax shelters themselves, okay? Those monies are available because your film qualifies. So you come to Canada, you shoot in Canada, you spend money in Canada, you hire Canadians for it, you basically get that percentage of tax credit. That can give you 20% of your budget, give you 30, 40% of your budget, depending on which credits we were knocking on itself. One of the other ways is that soft money is now available not just in Canada. It's available in lots of different states. It's available in lots of different countries. So maybe if you set your film not just in one country, but you partner with another producer in another country, you create what is called a co-production. That co-production permits you, in many circumstances, to access what is called the soft money of that other country. So we have some of the soft money in Canada, co-produce partner with soft money in Ireland, for instance, okay? And therefore, you're now accessing soft money in another country itself. And from these, apart from just those tax credits themselves, there are institutions in each of these countries who often support their film. So in Ireland, you've got the Irish Film Board. In Britain, you have a British Film Board. Here you have the telefilm agencies and so forth. That type of money is also soft money. Why? Because in many cases, even though they may want you to repay it back, there's no hard loan that says you've got to pay me back on December 31st of 5 years from now. It just basically says you'll pay me back with some money that's generated from the film. Again, that's a type of soft money itself. So those are the first monies that you run after, and gives you a certain percentage of your budget. Then what you're looking for are investors who are, let's call it equity investors. They're at risk, okay? In other words, people that believe in your film, they're willing to put up money and have a risk. This is the type of money most entrepreneurs have to go and find anyway, right? In any type of business. So that person, again, that investor is not making you a loan that says you have to pay me back this much money plus interest at this date. That investor is saying, I'll take a share of the film. Now, you spoke a little bit about what you called equity crowdfunding, right? That's the type of...
It's the same kind of structure.
Exactly.
I'm putting in money for a return on investment, or ROI, right?
But if there's no money, if the film doesn't generate any money, doesn't make a profit, they're not knocking down your door and taking over your house or whatever it is to get repaid back. That investor is what we call an equity investor. There are private equity investors. There is even public equity investors. There are institutions out there, and in many cases in different countries, who will invest in a film project themselves, and it's recoupable, but recoupable at risk.
And once we go above that, that's where we get into lending.
Now
right?
now we have issues. Well, no, there's another part of it. Okay, so and let's presume that whatever you whenever you make a film, the film's value from an economic standpoint is essentially its ability to generate revenues from around the world, or let's call it the universe, right? Sometimes we use that expression when you give away your rights, you're selling the universe, right?
Well, that's it. And the reason...
Maybe in Mars, they're going to do, showing soon, but
that's exactly why, right? Eventually, you want to cover Mars.
But that's the value of a film, right? So if we break down 100 different countries, right, as being all of the exploitable countries of the film, okay? If you go to one country and you say, hey, listen, I'll sell you my film for this country, okay? And you pay me certain amount of money based on the fact that I have this script, I have this director, I have this actor, okay? So you now have sold your film. You've pre-sold the value of your film.
And let's just jump in here, right? We've talked about talent agents. There are other kinds of agents, and this is where they come in, and they're called sales agents, right? These sales agents look at the package that you're bringing, right? They say, okay, this is a comedy film. Comedy films don't particularly perform well in X, Y, Z countries, but they perform very well in ABC countries. But it has this actor which attaches this value, and sales agents tend to have very, very set algorithms or ways of calculating the value of a certain film based on a certain package in a certain jurisdiction in the world. So that's where you see like ask take prices, right? Which is kind of your minimum, maximum prices that are reasonable in a given context. And your sales agent will actually go out and sell the film internationally on a jurisdiction by jurisdiction basis.
But you're selling your film. You see what you're doing there? The act of what you're doing. When you were going in with soft money, you hadn't sold anything, right?
You hadn't given up
all
rights.
you did is you decided to produce your film somewhere and you got money. When you went to an investor, you didn't sell your film yet. You sold what the film would generate, the revenues that the film generated. The moment that you go to a country or get a sales agent and that sales agent says, I'm selling Germany for $1 million or $500,000, you have basically given up part of your film. That film now, okay, for that country is almost set. If Germany all of a sudden is a huge hit, okay, you've given up a lot of that upside on it. So you've basically, let's say, economically tranched up your film so that to get your film made, if you sell 100 countries of 100, what are you going to make after? Zero.
Well, it's a business decision, right? If I'm a risk-loving producer, I'm going to sell less, and I'm going to bank on the fact that my film is going to do really well,
right?
And that it's going to generate more once it's released.
So your goal is to sell as little countries as possible, right? Leaving you with as many countries left to be able to make money.
If you're tolerant to risk and you think your movie is going to be great, absolutely.
Well, but you don't know this, right? Because when you're walking in, you got there, let's say a certain percent from other monies and equity investors. You don't know what you're going to end up getting and how much you have to pre-sell your film and give up of your film, pretty much. So my understanding is, and some film producers do this, is they pretty much sell the world. And then all they've made is the money they made in the film, right? Because if you produce your film and all the world is sold, maybe if that film generates an enormous success somewhere, okay, you're not going to see much money from that film because you've pre-sold it. In fact, my understanding also is that companies like the streaming companies like Netflix or Amazon, okay, they will buy your film
for a percentage of the budget, traditionally, right?
They basically will say, hey, what's the budget of your film? If your film is $5 million, $10 million, they may pay you $12 million or $11 million. Yeah,
like 125% of the budget was
of the budget of the film.
Number I heard
now
for
you've
one
made money.
streamer.
But they now, Netflix, actually take all the value of that film and it becomes their film, technically, okay? Even though you may keep the copyright. It becomes their film, and they're the ones that if this film all of a sudden has 1 million downstreams or whatever it is that they're, their business model is, okay, they end up getting that money. And you basically did a film, for a salary, or not a salary, for a certain amount of money that you put into your production. But if you would have been able to finance that film without having to make those sales, okay, and kept most of the countries, okay, then all of a sudden, if the film is a hit, you would be making an enormous amount of the upside.
Exactly. But now we have our pre-sales, right? Yeah. The important thing to realize, though, is there's two different ways to sell a film. One is I'm going to pre-sell it in advance of actually making it. The other is I've made it and now I'm going to sell it. And that's called the negative pickup, right? Because the distributor actually, you say, here's the negative of the film. Yeah. Traditionally, I'm going to pick it up and I'm going to pay you money and I'm going to walk away with the negative. But in the pre-sale context, the distributor who pre-buys the film, they only pay you a very small percentage up front. They pay you the rest on delivery. So that's all good and well. But the question for the producer is, okay, I needed this money to make my movie. How do I make my movie now? And that is where the lender comes in.
Okay,
right?
So let's explain that a little clearer, what you're talking about there. So I've got a certain amount of film. We're going to go later on into this in the other episodes. But if my film is $5 million, I don't have $5 million of tax credits, and I have $1 million tax. I don't have the tax credit, cash. If I pre-sell the film, the guy just paid me only 10, 20%, right? I need the other 80%, okay? And so you're saying what I have is a lot of people promising me to pay me money when I deliver them the film.
Or if you want to use legalese or business terminology, I have a bunch of receivables, but they're not received.
They're not received yet. So now I go to a bank. I go to someone who's going to lend me money, right? Because a bank, that's what they're in the business of. If a bank sees that you have receivables, which are assets that are down the road, okay, essentially they will be able to finance that receivable, okay, on a loan basis. You're able to say, yes, I can take that loan. Why? Because you know that if you produce your film, okay, and deliver that film, those receivables are paid, the bank is paid off. That's your lending side. Now, apart from that bank loan, okay, sometimes you try your hardest to try and sell the film, okay, and you don't succeed in getting all of your film financed with those pre-sales, okay? But you don't want to give up all the rest of the world. Remember, we just said, hey, if I sell the world, I may be able to finance my film, but I make very little from it. I make only my 10% that I did for doing the film, which was in the budget, okay? So, but I've sold 50% of the film. I have some tax credits that are giving me 30%. I'm missing 10, 15, 20%.
There is a, quote, gap in your budget.
There's a gap.
Right?
Yeah. And as easy or as hard, if you want, okay, as we just said the word gap, someone came up with the concept of gap financing. Gap financing itself is I haven't sold the world. I've sold half the world or 25% of the world. I have 75% of the world left. That's my economic value of my film. That 75%, if you look at the 25 that I sold, right, should be worth, I don't know, 200% of my budget, 300% of my budget. If I calculate what I pre-sold plus the estimates that I got from sales agents, like you said, the sales agents have been doing this for years, so they may know comedy film starring these people. We looked at the Hollywood Stock Exchange. Those people are generating a certain amount of money from their films and so forth. So we estimate that the rest of the world is worth 300% of what you're missing. There'll be someone who says, hey, I'll lend you money for that. I'll lend you money, but I want to be out right away because I'm the last money in to gap finance. I fill the gap, let's call it. But once you start making sales, I want to be the first money out. So interesting. We just got ourselves 100% financed. We didn't pre-sell the world, but I got somebody who give me a gap financing. Sounds like a really great deal now, right?
Well, there's also something called super gap. I will add for all of you out there, super gap is not a kind of gap financing that wears a cape and flies. It's something very, very different. I don't know if you want to go into that.
Well, the super gap means that the percentage is higher, right? So that there's a certain risk being taken by that gap financier, because the more gap you have, the greater risk there is that somebody actually can lose money.
Well, also, if you have a gap facility and a super gap facility, gap tends to be repayable sooner in time than super gap, right? So basically, the higher you go, gap is riskier than pre-sales, and super gap is riskier than gap.
Yeah. So the advantage we have with this gap financing is now all of a sudden we got the money. Okay, we're financed. We haven't pre-sold the entire world. Okay, but the gap, the one condition that gap financier gave you, okay, is he or she or it is the first one getting repaid, right? So when you go out to the markets, like we said, we're at the American film market, we're in Cannes, we're in TIFF, and we're receiving an offer for this film. And it says, for Italy, I'll pay you $100,000 or $500,000 for Italy. Somewhere in that gap deal was written that the gap financier had to approve that sale. So you no longer own the film. You no longer run that bus. You no longer have control of where you're making that sale. The gap, because the gap is now taking the risk, makes that decision for you. So on the one hand, you ended up financing your film by getting that gap financing in, but you gave up what is called the control of the bus or the control of making that sale. Because maybe what you would say as the producer is, I'm not happy with $500,000 for that country, okay? Because I think I can get more, right? And we'll go to the next market. We don't have to sell it at this market. There's another one coming. Remember, we said you can be literally all year at different markets, okay? And the gap says, no, I'm taking that sale. Why? Because he put up the money under the contract that you're going to sign with him. He chooses which sale he makes.
And then we're talking about sale. This is all financing of sales. And you remember when we said, okay, you only get 10% up front. You get 90% later on. Typically, like we've said already, you get that 90% when you deliver the film. Now, the question is, what do you need to deliver the film? You need a complete movie, right? So all these lenders are sitting there saying, we're financing these receivables, which are contingent upon completion of the film. How do we ensure completion of the film? That's something we kind of want guaranteed, right?
Well, if I'm lending money and my loan is dependent on the fact that that film is going to be produced and that film is going to be delivered to this distributor or to this broadcaster or sales agent who then can take it from there and pay their money, that risk itself, okay, has to be covered. And the moment we have risk, right, in this world, we've had a concept called insurance. And that concept of insurance, including the delivery and production of a film, is covered by something called a completion bond.
Or a completion guarantor.
Or a completion guarantor.
And they guarantee completion.
So essentially what they're saying is, hey, provided I have the budget of the film, okay, it will tell the financiers that I will deliver this film to those broadcasters, to those buyers on those days that are written over there. So what it did is it essentially removed the risk for the banks and for the financiers and the investors that film would or would not be delivered.
All right. So where does
big financial exercise? Yeah.
But all that said, where does this leave us now? Right? We've developed a movie. We have our script. We have our star-studded cast or dream team. We've gotten our financing structure in place. So now we need to go produce it.
Yeah.
Boots on the ground right?
Once we've signed it all, what actually occurred, if you think about it, is what we call closing. Okay. It's one of the interesting aspects of this film world and how we get involved is that we're involved in that last step usually, okay? Because a film is a series of rights, okay, which all are represented by contracts. That series of rights requires people to put up money to finance the budget of it, which is also a series of contracts. And the people who are putting up money put up the money when there are different sales done or distributions done or broadcasts are done, which is a series of contracts, by the way. And at the same time, soft money is required also when you meet certain requirements, which means a certain level of expenditures, a certain level of people that are involved, another series of contracts. The people who you're hiring, the directors and the actors who are contingent on coming onto the film, is another series of contracts. All those contracts, when you combine them all together, okay, technically meld into what we call closing. At closing, all of that has been signed. All of the pre-sales are in place. All of the bank loans are in place. Your bonds are in place. Your insurance is in place, and so forth. You sign that, and therefore, now you've greenlit the picture. You're ready to go and produce the picture.
Time to produce. Yeah. Time to get that movie to the world. And that's the
time for our next episodes that are coming up. As now the hard part may have been done, but now there may even be another harder part of actually getting the film made and put into the can.
Thanks so much for listening, everyone, and stay tuned.
Right.